Taxes are perhaps the biggest expense you're going to have in retirement. Understanding how you're taxed can help you avoid unintentionally paying thousands of dollars of your hard-earned retirement assets to the IRS. My name is Eric Bowman, and today we are going to be talking about marginal tax brackets and provisional income calculations. So let's start off with ordinary income tax brackets. There's a multitude of tax brackets. The lowest tax bracket says that if you have taxable income between $0 and $19,750, that you will pay 10% in taxes on those dollars. Now, the nature of marginal tax brackets is a little different than many people think. The next bracket is the 12% bracket, and you note that that starts at $19,751 and goes to $80,250. So here's what that means. What it means is you're going to pay 10% on the first $19,750 of income, and you're going to pay 12% only on the dollars that exceed that $19,750. So from $19,751 to $82.50, you're going to pay 12% just on those dollars. It does not mean that you're going to pay 12% on all of your income because you're in the 12% tax bracket. And this allows us planning opportunities. Another way to visualize the income tax brackets is to look at what we call a tax map. So in this tax map, the one thing that's a little bit different is we see this flat area here that seems like it represents a 0% tax bracket. Well, there is no 0% tax bracket, but what it does represent is the standard deduction. So a married filing joint couple who's under the age of 65 has a $24,800 standard deduction, which means their first $24,800 of income, they pay no taxes on. So that's synonymous with a 0% tax bracket. Then we bump up into these 12, 10, 12, 22, 24 tax brackets and so on. Now, the reason I show this though is we can see that there's planning opportunity, and the planning opportunity usually lies within the dramatic moves or changes in the tax map. For example, here we see a big stair step up from 12% to 22%. That's a really big increase. This is the opportunity space for planning strategies to help alleviate or limit the amount of dollars that are going to jump up and get taxed at 22%. Likewise, when we see long plateaus like the 24% bracket and then another pretty meaningful step up, we want to see what we can do with this arena in order to minimize taxes and try to prevent our clients from hitting that 32% tax bracket if it's possible. So back to the standard deduction, we just want to get a quick primer on this because it's important to all of our examples. If you're under 65 and you're married, your married filing jointly standard deduction is $24,800. If you're over 65, it's $27,400. And if one spouse is over 65 and one is younger, then it's going to be $26,100. That's the standard deduction, the amount you can reduce your taxable income by just by being married filing jointly. So what is a marginal tax bracket? And I touched on it in the tax map, that red tax map we just looked at. But what it really means is if I draw another taxable dollar from an IRA or maybe from wages earned, what will that dollar be taxed at? So if you're in the 22% tax bracket, it means your next dollar of taxable income is going to be taxed at 22%, and you would pay 22 cents on that next dollar. Let's look at an example to show how the marginal tax brackets work. Example 1, the green block represents $60,000 of ordinary income. And what we're going to do first is apply the standard deduction of $24,800. So we don't pay any taxes on this. Above it, though, we're going to be subject to taxation based on ordinary income tax brackets. From $0 to $19,750, we're going to pay 10% on this income. And then we're going to pay 12%. This is a pretty broad tax bracket here from $19,750 to $80,250. And you're going to pay 12% on these dollars. So to break that down, there's $1,975 in the first tax bracket, and then 12% of the remaining $15,450 or $1,854 for a grand total estimated federal income tax of $3,829. Example 2, we're just going to double the income. Somebody has $120,000 of ordinary income. The first thing we're going to do is to take out that standard deduction of 24.8. We're going to apply the traditional marginal ordinary income tax brackets. So that means we have our 1975 due on that first 19,750, which is 10% of 19,750. And then we have our second tax bracket where we pay 12%, and the area between the two dotted lines is $60,500, total tax of $7,260. And then a little bit is seeped into the 22% marginal tax bracket. So $14,950 is going to be multiplied by 22% to give us a $3,289 additional tax. Add all those together, $12,524 in federal income tax. And I think a key note here is you've doubled your income from 60 to 80, from 60 to 120,000, from example 1 to example 2, but you've tripled your federal taxes. So keep that in mind as we think about trying to reduce taxation. There's an ample opportunity with the good thorough knowledge of these tax brackets to be able to do that. Capital gains tax brackets, married filing jointly, 2020. $0 to $80,000. If the only income you had was long-term capital gains, you would pay nothing on the first $80,000 of long-term capital gains. Everything over 80 to 496,600, you would pay 15%, and then you would pay 20% for everything over that. There is a difference between long-term and short-term capital gains. This is long-term capital gains. Short-term capital gains, which are defined as profit on an investment that you held for less than 1 year, so you held it for a short period of time, is taxed at ordinary income tax rates. If you held it for over a year, then it's going to be taxed according to these tax brackets. So example 3, let's mix in some long-term capital gains. We have our ordinary income tax. We have 60,000 of long-term capital gains. That means I made a distribution of maybe 100,000, but 60 of it was subject to long-term capital gains. So we still have 120,000. You remember last example, in example 2, you had 120,000 of ordinary income and you paid over 12,000 in federal taxes. Let's watch the difference here. Standard deduction applies. And do note that we stack the long-term cap gains on top of the ordinary income, and it's imperative that you do it that way. Now we apply ordinary income tax brackets to the green block. So we're going to have some 10% of the 19,750. We have a little bit being subject to 12% for 1854 tax burden. And then on the right side, the parallel long-term tax bracket system is in play. And what that means is that everything in the purple that falls below the dotted line of that $80,000 first bracket is taxed at 0. So on 44,800 of long-term cap gains, there's no income tax in this example. And the little bit that exceeded the 80,000 is taxed at 15%. If you add all of these up, you get a total combined federal tax, federal income and capital gains combined of $6,109. So let's take special note. 120,000 of income, half the taxes, 6,000 as opposed to over 12,000 in taxes. This hints that there are tax strategies that if you understand these and you have a diversity of accounts available to you, that you could potentially just be smart about how you distribute on an annual basis and potentially save on taxes. So one way to think about that is think about this fruit tree with a diversity of fruit on it. And you need to feed yourself, you need to sustain yourself, and you're going to pick from each and every one of those so you get a diversity of vitamins and minerals and other nutrients. Well, likewise, in retirement, you're going to be making distributions from IRAs that are subject to ordinary income tax. You're going to pay no tax on distributions from a Roth. And if you don't have a Roth IRA, you should be working with an advisor that can help prepare you for retirement by analyzing the potential benefit of Roth conversions. Extremely important strategy right now before taxes increase. Non-qualified money, which means fully taxable and subject to either short-term or long-term capital gains. And then Social Security is taxed totally different. And we're going to talk about that in the provisional income calculation in a moment. But the bottom line is, if you can pick and choose your money from that tree, from a diversity of account types, you can still meet your income needs and potentially lower your taxes at the same time. So let's transition into the provisional income calculation. Once again, the provisional income calculation is step one in determining how much of your Social Security will be subject to income tax. And the calculation takes 50% of the household Social Security plus all ordinary income, plus dividends and capital gains, municipal bond or non-taxable interest, and you add all those together, and that gives us a number that's called your provisional income. And then from that number, we apply thresholds to determine what percentage of that Social Security is going to be taxable. And rather than read this grid, I think the easiest way to do it is through an example. But before I get into that, let's just define ordinary income. Some of you may be wondering what is considered ordinary income. W-2 wages from working, IRA distributions are fully taxable as ordinary income tax. Pensions and short-term capital gains are subject to ordinary income tax, and non-qualified dividends, royalties, and a few other things. So, step one, calculate provisional income. Step two, use the thresholds to calculate how much of your Social Security is taxable. And then step three, take that taxable amount and then use that to determine your federal income tax. Once again, easiest way is with an example. So let's use an example where we have $20,000 of ordinary income and $40,000 of Social Security income. Well, the provisional income calculation says take 50% of our Social Security. So Social Security was 40, 50% of that is 20. All of our ordinary income, which is 20,000, and add those together, we get a provisional income number of 40,000. Now let's apply the thresholds. The first threshold of 32,000, all dollars prior to that show no taxation. Once you exceed 32,000, up to 50% of those dollars could be subject to taxation. In this case, 50% of this 8,000, represented by the blue box above the first dotted line, means that we have $4,000 of Social Security taxable, or another way of saying it, 10% of your Social Security, because it was 40,000, is going to be taxable. So that sounds like a pretty good deal. Well, let's see what that looks like when we calculate your taxes. We have our ordinary income of 20,000. We add our taxable Social Security of 4,000. Take away our standard deduction of 24,800, and what we find is our taxable income is less than the standard deduction. Therefore, we pay zero in federal income tax. Example two, let's just reverse it. Now we're heavy on ordinary income and lower on Social Security, 40 and 20 respectively. First thing we do is calculate the provisional income, all of our ordinary income, half of our Social Security. Now we have a provisional income number of 50,000, contrasting with 40,000 in the previous example. Now let's calculate how much of that Social Security is taxable using the two thresholds. And we find that we pay a total of $11,100, or 55% of our Social Security is taxable, simply by rearranging where we're getting our income from. By having more ordinary income and less Social Security, we're going to pay a larger amount in taxes on our Social Security benefits. Now we're going to take that number and add that taxable Social Security amount of $11,100 to the $40,000 of income, and we're going to put the standard deduction in there. Let's apply our ordinary income tax brackets, and we can see that we would have a total income tax burden of $2,761. So now that we've gone over all the marginal tax brackets and how Social Security interrelates to that, let's add in a third piece. It'll seem a little complex, but now we want to talk about cap gains and how that's going to work in this. First of all, what is a cap gain? A cap gain is simply the profit from the sale of an investment. If you held it for less than a year, you will pay short-term cap gains, which is ordinary income tax brackets. If you held it for more than a year, you're going to pay long-term capital gains, or long-term capital gains tax brackets. The synopsis of this slide is never forget that even if the provisional income calculation ends up saying, hey, you have to pay taxes on like all of your income and all of your Social Security, the formula is a little more discreet than that. And it says you're going to do the provisional income calculation and you're going to multiply your Social Security by 85%. Whichever one is lower is the amount of your Social Security that's taxable. So let's take example 3. We've added 50,000 of capital gains. We have 60,000 of combined household Social Security, and we have $60,000 of ordinary income tax. Okay, now we're going to use this provisional income calculation. We're going to take the ordinary income tax, 50% of Social Security, but we need to add that purple icon, the capital gains, on top of that. Our provisional income number now is 140,000. So we've calculated that. Step 2, how do we use that provisional income number to calculate how much of our Social Security is taxable? We're going to use those 2 thresholds again, apply the thresholds, and we come up with a number that seems a little out of this world. It says 87,600 of your Social Security is taxable, but you've only made 60,000 in Social Security wages. So we have to remember, the other calculation is take 85% of that 60,000, which is 51,000, and you choose which one is lower, and that becomes the taxable portion of Social Security. So in this instance, we're going to use that 51,000. We select the lesser answer. Now let's calculate taxes. We have ordinary income tax, we have ordinary income of 60,000. We have taxable Social Security of 51,000 that we just calculated. And then we have long-term capital gains of 50,000. We're going to take the standard deduction of 24/8, married filing jointly, younger than age 65. Let's apply the ordinary income tax brackets first. And we see we're going to pay $1,975 on the first $19,750 of income. And then we're going to pay 12% on $60,500 of income, which is then right here, right up to that $80,250 in ordinary income tax bracket. And then there's a little bit of our ordinary income that crept into the 22% bracket. But we still have this cap gain up here. And how does that work? Well, don't forget that the cap gains first tax bracket really starts at $80,000, and it's only for capital gains above that 80,000 mark that are subject to 15%. So in this case, 15% of 50,000 is 7,500. Total combined federal income tax and capital gains tax is $18,044. Note that it's really important that in the way we calculate this, that you put the capital gain on top of the other taxable ordinary income. Otherwise, the calculations won't work out. We, of course, use software. We have very intricate software that allows us to calculate these taxes on the fly and with a great degree of accuracy. This is meant as an illustration, but to recall that the cap gains is income and it gets stacked on top of your other income. Now, let's just switch one thing. Instead of making that capital gain long-term, let's just assume that you sold it all in less than a year and you incurred this $50,000 of capital gain, but it was short-term capital gain. Well, now capital gains tax brackets don't apply because short-term capital gains are subject to ordinary income tax rates. So we're going to just apply the 10, the 12, and the 22% tax brackets, and you're going to pay $21,544. So let's see if we can go back one and take a look. 18,000 when you have some long-term cap gains in the mix, and 21,000 if it's all ordinary income. That should hint to the idea that there are strategies to allow you to manage your tax brackets. It's interesting. When you are working in W-2 wages during those, age 20 to age 60-year-old time frame, just as an example, you really don't have much control over your taxes. You're not going to take a pay cut to pay less in taxes, so you have to pay what you have to pay. But in retirement, you actually have tremendously more flexibility to be able to manage your taxes if you have a diversity of accounts from a taxable perspective, which goes back to that tree. We like to see our clients set up with Roth, IRA, non-qualified, and Social Security so that we can make very tactical decisions on how we're going to distribute to get them the money they need and to pay the least amount of taxes possible. So what are some opportunities? It's fine that we know all the details of how to calculate taxes, and it seems almost too complex in some respects. However, understanding them allows us to make decisions so that we can seek opportunity to help our clients. So let me orient you to this slide here. This is a slide showing roughly a 10-year period. We have a married couple, both are the same age. Here's age 63 for both of them, and we're going to show that decade from 63 to 73, which are the formative years of retirement. Social Security decisions, pension decisions, part-time work, full-time work, one spouse quitting. I mean, there are so many things that happen during this 10-year period, and most people just don't understand how important it is to not only understand that these decisions have to be made, but that creates opportunity to save on taxes. So let's just walk through here. On the left side, we show ordinary income tax brackets. The green bars represent ordinary income. In this example, that ordinary income is derived from both of them working. So combined income is well over $170,000. On the right side, we're showing long-term capital gains tax brackets, and we'll get to that more in a moment. So in year one and year two, they're both working, they're making good income. COVID-19 hit them a little bit, and they had to cut back on their hours a little, which is why they have a little less income. But then at age 65, one of them retires. So they have a major drop in income, but they're still over this $80,250 income tax bracket, and they're still over the $80,000 long-term capital gains tax bracket. At age 67, they both retire. No earned income coming into the household. They've got a couple $100,000 sitting in their checking and savings account, and they decide they're going to use that money to live on for this year. Well, it does afford them some opportunity, because here's an example. Imagine that the lady of the house inherited significant money from her dad who passed away 20 years ago. Well, when she inherited that money, she received what was called a step up in basis. That money, the value of that money, or the quote unquote purchase cost of that money, was the value of those assets, the stocks and bonds that she received on the date of her dad's death. It's from that point, the growth from that point on, that are going to be subject to long-term capital gains. Well, 20 years later, there's so much long-term capital gains, they probably feel like they have no opportunity to offload any of those holdings without paying 15%. Most people think if you have any long-term cap gains, you're going to simply pay 15%, and it's just not the case, as we just reviewed. So maybe they decide that they're going to go ahead and sell some of those holdings. Matter of fact, they're going to sell enough to generate $80,000 in long-term capital gains, but because they don't have any other income, they're going to pay the 0% tax bracket on marginal long-term capital gains. So that actually was a pretty meaningful decision to make, because now those dollars can be reinvested and grow again, starting at a much higher basis. Now they decide to go back to work, because after doing that year and spending so much money from checking and savings, they realized, well, maybe that wasn't the best idea to spend all that checking and savings money. Let's go ahead and preserve some of that non-qualified money in our savings account, and let's get some part-time work for a couple of years. And so they do just that. But what we notice is there's this gap here, and this gap represents opportunity to do more of this tax gain harvesting. And we could do that in each year going forward, even when the blue represents Social Security. Even when they turn on Social Security, there's still room to utilize this strategy. So if you're sitting in a position where you have a low basis, many years of growth, and a lot of long-term capital gains, these are the types of ideas you should be talking about with your tax professional or your financial advisor. It's certainly at the top of our list with clients that sit in that situation. And then they hit age 72. At age 72, based on the new Secure Act law that went into effect January 1st of this year, that's when required minimum distributions are now due, depending on your age, your date of birth. But that green represents distributions from their IRA, Social Security on top of that. They kind of lost some of their strategic opportunity at that point. What this shows is many of these strategies are time sensitive. The sit and wait methodology to see what happens next year is simply not the most effective way of deploying retirement strategies. You have to do them while the getting's good. And right now, tax brackets are probably the best they're going to ever be in your entire lifetime. And they are slated to expire January 1, 2026 under current law. They just disappear and they go back to the old higher tax brackets of the previous administration. Take note, Congress could change tax law tomorrow and they could get rid of that sunset provision and actually increase taxes tomorrow. So you need to sit with your financial professional and understand if you have Roth conversions or tax gain harvesting available to you right now, because right now is when you have the opportunity. A couple of years from now, or maybe as soon as next year, that opportunity could be lost. So let's talk about Roth conversions. So this is the exact same slide, except we're substituting Roth conversions for long-term cap gains. So both of them working, husband and wife, one of them retires, they take a gap year here at age 67, and what they've created now is the opportunity to do Roth conversions, meaning move money from a traditional IRA into a Roth IRA, pay the taxes in the year of conversion, that's important to note. But because they don't have any other income, the highest tax bracket they're in, they can convert over $80,000 of that traditional IRA at no greater than the 12% marginal tax bracket. The mixed rate's going to be somewhere between 10 and 11. And there's exemptions at the Colorado state level that one should know, and we talk about in our Roth conversion webinar. And then, of course, they start their part-time work again, but we still have the same type of opportunity to do multi-year Roth conversions to maintain that lower tax bracket. And now all of those dollars in purple could be subject to growth through investments, and all of the growth, all of the principal is now tax-free for the rest of your life. And importantly, tax-free to your children if you leave them money. There was a recent law change as part of the Secure Act that said if you leave your child, a non-spouse, a traditional IRA, they have to liquidate that account in 10 years down to zero and pay all the income tax. If you have children that are well off and dual income, having to liquidate a really sizable IRA could result in a massive tax hit to them, which means the money you worked so hard for is going to go back to the federal government, potentially to the tune of 32% or greater. So Roth conversions have a multi-generational benefit in some instances. So once again, my name is Eric Bowman, Retirement Income Certified Professional, certificate holder of the National Security Association, National Social Security Association. I run a boutique financial planning firm here in Englewood, Colorado called Bowman Financial Strategies, where we focus on helping people transition from accumulation to distribution, and then with all of the ongoing distribution management for decades to come. I look forward to speaking with each and every one of you. If you're an accountant and you want to reach out to us and talk about how we may be able to help your clients or help educate you and your staff, just give us a call the same way by scheduling. If you're what we call a retail client, somebody out there who's planning for retirement and you know you've got some gaps in your plan, I sure hope you take advantage of this complimentary opportunity. And I look forward to hearing from you all. Have a great day.